As a Canadian, how can one invest in US stock? Convert your Canadian dollars to US dollars and deposit in Questrade and use that to buy US stocks? Or use Wealthsimple and buy using Canadian dollars? In both the scenarios, you have to pay a fixed exchange rate. But wait, there is another way. Hi, welcome to my channel where we talk all about stocks, Canadian dividend stocks, analysis, portfolio walkthroughs, and so on. In today's video, we will go through a different way to invest in US market. If you want to invest in a global company, you typically have to do so in a different currency, which means you'll have to pay currency conversion cost of 1% or more. As a retail investor, that will add up to a considerable amount of money. The alternate to this is by investing in Canadian Depository Receipt (CDR), a new type of security that gives you exposure to shares of global companies but are traded in Canadian dollars on a Canadian exchange. For years, American Depository Receipts, known as ADRs, have been trading in the United States to make it easy for people to buy shares that are listed in foreign countries. These foreign stocks are traded just like publicly traded American companies. Inspired by this, Canadian Imperial Bank of Commerce recently introduced the first Canadian Depository Receipts (CDRs) on the Neo Exchange. CDRs represent shares of global companies but are traded in Canadian dollars on a Canadian stock exchange, making it easy for you to get exposure to the world's biggest companies. CDRs are a lot like traditional stocks. They trade on an exchange, flow through dividends, and have voting rights. The main benefit of CDR is that since we are buying it in Canadian dollars, we don't have to pay the exchange conversion rate. In most cases, your biggest cost when investing in a foreign stock is the conversion fee from Canadian to US dollars, which is usually between 1% to 1.9%. With CDRs, CIBC is making those stocks available at fees that large institutions pay, which is a huge cost benefit compared to any other way of getting access to these larger global stocks. Along with that, it also removes the effects of currency fluctuations from any returns obtained by a stock held in a different currency. That is, the CDRs are currency hedged. The bank explains it in this way. The CDR ratio is automatically adjusted on a daily basis to account for the notional currency hedge. If the Canadian dollar increases in value compared to the US dollar or other relevant foreign currencies, the CDR ratio for each CDR is adjusted to represent a large number of underlying shares. Conversely, if the Canadian dollar decreases in value compared to US dollars, the CDR ratio for each CDR is adjusted to represent a smaller number of underlying shares. This means your return depends on the performance of the underlying shares, eliminating the currency fluctuations. Another advantage is that CDRs can be bought in fractional shares, making companies with very high stock prices more accessible to small retail investors. So, in Wealthsimple, we do have an option to buy fractional shares of Tesla, Amazon, Microsoft, etc. But those still require US dollars. So even if we are buying for 20 Canadian dollars, we have to pay a flat conversion of 1.5%. But buying the CDRs of these stocks, we can eliminate this fees. CDRs are available for a wide range of companies. They include Visa, PayPal, Microsoft, Amazon, Netflix, Apple, Disney, Tesla, Google. Another advantage of CDR is that they don't charge any ongoing management fees such as mutual funds or exchange traded funds do. In actively traded mutual funds, management expense ratio can be 2.5% or more. So how does CDR price vary? The CDR fractional shares go up and down depending on how the underlying stock is trading that day on the NASDAQ. What about the dividends? Dividends paid on the shares Underlying CDRs are passed through a CDR investors in Canadian dollars when received. Taxation of CDR dividends is the same as it is for dividends paid from a US listed stocks. Those dividends are considered regular income if held in a taxable account. The dividend tax credit does not apply. Within your investment amount, expect a foreign withholding tax to be applied to dividends paid by US companies and CDRs. So that's it from my side for today. Hope you learned something new by watching this video. If yes, please like this video, and if you have not subscribed, please do. Thanks for watching.